concern over the health of its U.S. education business sent shares in Pearson tumbling. The publisher's stock fell 4.7%, or 33.4p, to 685p, after revealing a drop in sales in its U.S. textbook division as cautious customers put off spending. The publisher, however, reported a 2% drop in sales for 2017, largely driven by a 4% fall in its North American operations, where sales of U.S. higher education courseware dropped 3%. It said its 2018 profits will be below levels recorded last year and forecast a profit of between £520 million to £560 million for 2018. Pearson's North American business is vulnerable to the slowdown in America's for-profit college enrollments and the rise in people renting textbooks. Its online educational resource platform is also facing increased competition. George Salmon, an equity analyst at Hargreaves Lansdown, said, "When a company raises profit guidance, it is usually accompanied by a glowing set of numbers. That's not the case at Pearson. The uptick in profits leans on a more favorable-than-expected tax rate, and the improvement in net debt has been driven by the disposals, such as the sale of its 22% interest in Penguin Random House." He added that, while digital revenues were growing, that growth was on the back of a move which slashed prices on 2,000 titles. The FTSE 100 was down 0.4%, or 30.5 points to 7,725.43 points, while the FTSE 250 fell 0.5%, or 107.94 points to 20,769.36 points. Health stocks Mediclinic International and NMC Health were among the biggest gainers on the blue chip index thanks to favorable upgrades from Jefferies. Mediclinic soared 3.1%, or 18.8p, to 619p after the investment bank said it expects the company to meet its long-term performance targets for 2019. NMC Health rose 1.6%, or 50p, to 3,152p despite Jefferies giving it a hold rating and maintaining its target price at 3,085p. FTSE 250 firm Spire Healthcare also jumped 3.5%, or 8.4p, to 250p after Jefferies gave it a buy rating and said it had a customer advantage to its scale and exposure to the UK private hospital sector. Retailers Debenhams and Marks & Spencer finished lower after Liberum dubbed them Christmas losers. The bank, which gave both stocks a sell rating, said the struggles facing traditional retailers are persisting. Asos and B&M were among Liberum's Christmas winners, up 0.1%, or 6p, to 6,760p and 0.1%, or 0.6p to 417p respectively. Office space rental firm previously known as Regus, jumped up amid rumours that Canadian firm Brookfield Asset Management is planning to put in another bid. Brookfield submitted a £2.5 billion offer for Regus in December, alongside private equity company Onex, but the bid was rebuffed by the company, which claimed it was too cheap. Brookfield, which has just 2 days to make a firm offer under put up or shut up rules, is rumored to be preparing a heftier bid for the firm. It has 3,000 office locations worldwide, and it operates a series of flexible shared offices under the Spaces name. It increased 0.6%, or 1.6p, to 266p following the news. Provident Financial was again dealt heavy blows following its £120 million write-down in its doorstep lending arm. Its shares dropped 13.1%, or 105p, to 699p yesterday, meaning £313.7 million has been knocked off its market value since revealing the write-off on Tuesday.